pleasure that we are beginning it with an absolutely fresh presentation to you, which we will be attempting to bring to you what has been proposed and so passed from Finance Act 2021. Then DTRTI Lucknow is going through a tough time at the moment because some of our officers are, including our ADG sir, have been detected positive on corona, and therefore some of the other officers are also in quarantine. Therefore, we are not going to do a very formal inauguration of this webinar, and we will delve straight away into this webinar. Let me introduce you to the DTRTI team at the moment. We are headed by our ADG sir, Vivek Kumar, who is an IRS officer of 1992 batch. We have our joint director, Sri Mohan, and we have three deputy directors, including myself, Sri Nagendra and Sri Rajesh Tiwari. Of course, we have four additional assistant directors, Treasury Department, Sri Asina Chaudhary, Srimati Poonam Verma, and Sri Ram. We have our team of income tax inspectors who are coordinating the courses at that time, and you already know that this course is coordinated by Manoj Sharma and our tax assistant, Saima Khan. Of course, we are also assisted by our stenographer, Vinod Kumar. The DTRTI has about 30 people on its roll now, and nowadays we are conducting about 65 courses every year. In order to conduct every course, we have to go into a lot of detail to prepare the course and get the best possible faculty for you. As well as usual, it's a very exciting thing, and it's a matter of great discussion among all the employees of the department. And as I believe that recently it has been enacted also in Finance Act. So it becomes our bounden duty in a way to look into all aspects of it, to internalize them, so that while using them, we do not commit any mistakes. We are very proud to welcome Sri S. Ramakrishanan, who is the PCIT coaching. Ramakrishanan has earlier also worked as ADG at DTRTI Chennai, and I have the pleasure of informing you that Sir is a graduate in commerce. He has also done his cost and management accountancy in 1991. Sir is also got the certification of the associate as an associate of the Indian Institute of Bankers. He received in 1987. Sir also has the online certification. Sir has done his online certification course on leadership from IIT Kharagpur 2020. He had undergone a foundation course for the civil servant at the Indian Police Academy, Hyderabad. Thereafter, the IRS training had happened at the National Academy of Arithmetic, belongs to the 1989 batch, the 41st batch of the Indian Revenue Service. There is also there is a computer for management application degree from the Anna Institute of Management Chennai. There has been delivery lecture at number of DTRTIs as well as NAD. He is also the member of the Mediation Committee of HRIS, the Directorate of HRD. He is also a member of the Action Plan Target Committee and of the Infrastructure Committee of the CBC. There is also undergone posting in the corporate tax circles, in investigation, in alternate dispute resolution, training, and in administration. Before joining the Indian Revenue Service, there has also worked as a probationary officer at the State Bank of India of Mysore, as well as an assistant development officer at NABARD. Sir has a small family of two, apart from his spouse, and from our personal experience, we are well aware that Sir is very disciplined and very hard work and innovative officer. We look forward to getting the best talent to keep holding. There is a finance expert by training as well as by experience. Therefore, it gives us a great deal of pleasure today to invite him to deliver this session for us. Sir will be taking you through the provisions that have been used and be analyzing them and talking about them. But without your participation, it will not work out to that extent as it can. So please feel free and try to express yourself. Whatever you want to say about any provision, or you want to express any view, or even ask a question. However things will be, please ask questions, not just for your own benefit, but also for the benefit of all the other participants who are participating in this webinar, and for others also who will be looking at the video of the webinar later on. With those words, I invite our guest speaker, P.S. Ramakrishanan, who is speaking from Kochi. There is a PCIT Kochi at the present moment. And I welcome him to DTRTI Lucknow webinar and invite him wholeheartedly to kindly begin the presentation for today.
Good morning, Arvind. Am I audible?
Yes, sir, you are audible.
Yeah, thanks, Arvind. Mr. Vivek Kumar, ADG, DTRTI Lucknow, my dear friend Arvind, and team DTRTI Lucknow, it gives me immense pleasure to take this session on Finance Bill 2021. I thank Arvind especially for giving me this opportunity, because this invitation came just a couple of days back, so I hurriedly made my preparation. I hope I'll be able to do justice to the task given at a short notice. But before I formally make the PowerPoint presentation, I would like to make few statements which will give you a general overview of what this finance bill has been. Revival of economy has been the forefront of the government concern during the last 1 year post-pandemic, and Income Tax Act has come in very handy for this purpose, with government going in for a major PSU investment. So aggressive disinvestment is being planned this year. So corresponding amendment has been made in the Income Tax Act to take care of this aspect. The second factor is government does not think the business community alone when it comes to doing right condition for activity in the economy, because economy depends not only on business community alone, it also depends hugely on other communities such as hospitals, universities, and other institutions like NGOs. So this is one budget where I find that lot of rationalization has been done so as to make even compliance burden of other institutions also less cumbersome. This is one important factor which I could notice. Then Atmanirbhar, that is the catchword of the government and also the policymakers for the last couple of years. And in view of this, startups are given further incentives in this particular budget. Then like housing for the affordable section of the population has been one of the cornerstones of the policy making of the present government. And in that connection, Section 80 IAC has been fine-tuned. Similarly, safe harbor rules have been put in place for home buyers. So this is one more aspect which will give a lot of glee to people who would like to buy a property. The ease of compliance for senior citizen is a novel feature of this particular budget. So, like that is one thing which has been debated very heavily in most of the. Am I audible, Arvind? Am I audible? Yes. Okay. Then, ease of compliance has been one of the aspects which the government has been trying to emphasize upon, and senior citizens have been given specific benefit in this particular budget. Then certainty of tax procedure is an important thing which actually attracts a lot of foreign investment. So this is one area where a slew of amendments have come this year. One is the reopening provisions have been given a major engineering. Secondly, reducing the time limit for issuing notice under 142. Then time barring date correspondingly is one of the factor which also makes the budget very interesting for the taxpayers. Taxpayers feel now there is more certainty, and huge amount of foreign investment is definitely expected with certainty in tax procedure. Then major changes in the way we work, like for the department has been receiving huge amount of changes in the way we do work.
Namaste.
Yes, please. Hello. Am I audible, please?
Yes, sir, you are
Hello.
audible. The participants are requested to keep silent.
Sir, you are audible,
Want
sir.
to ask a question?
Yeah, okay. Thank you. I'll continue. Then major changes in the way we work. Such assessments have been modified. Then faceless ITAT is the order of the day. Then we have no more settlement commission. Then advance ruling is going to come in the form of a new avatar. Then after Government of India had to face the backlash after ILFS scam and huge NPAs in banks, it was decided that probably there should be policy should be in place, and obviously the income tax provisions are one of the supplementary provisions which makes the government policy sweeten for the investors. Accordingly, thirst to infra fund is one of the major hallmark of this particular budget, where now we are going to have a huge amount of sovereign wealth fund and pension funds are going to funneled into infrastructure, because Government of India is having a very ambitious plan for infra fund. So they all would like to have this funding coming not from the banks, because as you all know, banks actually borrow for short term. So obviously is supposed to invest only for short term loans. So they are not supposed to go for long term investment in the form of term loans. But over a period of time, what has happened is, due to acute shortage of infra funds, which actually can give loan for long term purposes, banks have been prodded to go for consortium fundings, where multiple banks join together and take risk of long-term funding. With the result, what happens is there is a mismatch of their assets and liabilities. Asset liabilities mismatch has been a big problem. Most maybe when you make an analysis of NPS, you do find that part of NPS is not really account of solvency issues. It is only on account of asset liability mismatch. If banks borrow money from you as a SB account holder, you can withdraw anytime you want. So whereas if the same money is deployed with the bank for a loan of 3 years, then as and when you withdraw a huge sum of money from your savings bank account, definitely bank is going to have feel the pinch. There will be an asset liability mismatch. So this thirst to infra fund from legitimate sources is the biggest plus of this particular budget, I would say, where ILFS scam and NPS in banks have actually made the government realize that probably government should put in place infra institution which can actually tap legitimate sources both in India as well as abroad for the purpose of infrastructure funding. So this is one thing which is a very important factor post-COVID, when government actually expect that there should be more revival of economic activity. Infrastructure funding has been one of the important aspects which the government will look into. So where once we have a institution in place willing to bank infra projects, viable infra project, fund is not going to be a problem for them. Then ease of tax compliance, pre-filled forms will consist of even interest and dividend details. Then tax audit limits have been enhanced. So no more the tax audit is required for fairly big chunk of MSMEs. They can go ahead and file their returns if they are coming within that particular bracket. Then you do have advanced tax rules have been fine-tuned so that if a dividend is going to be received, which you are not very sure, then advanced tax compliance burden will actually unnecessarily create problem for people who receive dividend. Then, like on the one hand, as I was going through the provisions of finance bill, I also realized that the proposals do have certain provisions where loopholes are also being plugged very meticulously. One thing which I could notice was that high net worth individuals and institutions were trying to tap the provisions which were actually intended for small and medium scale taxpayers. Like this ULIP is one. Then tax on interest on provident fund is one, where government has correctly come back and decided that maybe beyond an investment in GPF, the interest should not be allowed to be exempt from tax. So these are some major highlights which I could see as I was going through the provisions when I was preparing the PowerPoint presentation today. So having given the broad overview, now I'll just take you through to the provisions of the finance bill step by step. Now I'll just share my PowerPoint presentation with you.
Yes, sir, we are able to see your screen.
Now you're able to see my screen, right?
Yes, sir. Yes, sir.
Okay, thank you. The first provision which I'm speaking about is section 194P. This is a provision intended to make senior citizen to prevent them from filing income tax return, because income tax return filing has been one of the difficult tasks, especially for senior citizens, especially if they are going to be of more than 70, 75 with technology kicking in. So it has been decided that senior citizens of 75 years or more are exempted from filing return of income, subject to condition that she or he has only one source of income, that is pension, and receiving interest income from the same and single savings bank account, and file declaration to that effect to the bank. That is, here the banks are going to be specified and are to be notified. So in other words, this is a scheme intended for a very specific target group. Maybe a senior citizen having multiple source of income and also dabbling in stock market and active, obviously may not like to get into this sort of a thing. Maybe this is basically for passive senior citizens who basically receive income from pension and also invest their money loyally with his own banker. So that banker, most likely to be notified, will be able to provide this value addition service to this particular taxpayer. So section 194P is basically intended only for this particular target group. So we need to look at with this particular need in mind. Of course, I was going through quite a few like interactive session on this budgets where quite a few people were highly critical of this particular provision. But I feel that probably since this is actually designed for a particular target group, like over a period of time, they like we see that if you take a sample of about say 100 senior citizens, you find only maybe about 10 to 15 of them have variety of portfolio of their income. Otherwise, you find that predominantly they have a they always like to keep their economic portfolio or financial portfolio very simple and straight. They don't want too much of complication. So actually, this 194 P is perfect recipe for them. So this will be interesting scheme, and definitely the need-based people will definitely opt for this scheme. And backers are also, they don't really grumble, because actually along with senior citizen, they also get huge amount of passive investment. Like when I was talking about this asset liability mismatch, senior citizens fixed deposit is one of the bedrock of most of the PSU banks of the country. So 194P is going to be sold by most of the public and private sector banks to rope in huge amount of fixed deposits, which will be quite solid for them. So even banks, in addition to the department, even bank will be promoting this. Then tax rates and optional rates of taxes. No change in the rates of taxes for this year for any category of taxpayers except cooperative societies who are being provided parity with domestic companies by introduction of
So we are able
1.
to see only the first slide.
Okay, the second slide you are not able to see?
No, the first slide, finance bill.
Yeah, finance bill, okay.
The tax rates.
Yeah, tax rates and optional rates for taxes. Now you are able to see?
Yes, sir.
Yeah, okay. Yeah, no change in tax rates for this year for any category of taxpayers except cooperative societies who are being provided parity with domestic companies by introduction of section 115 BAD, as per which they have opted to get taxed at 22% plus 10% surcharge and 4% cess. Actually, when finance minister was announcing various incentives for domestic companies, I for one was feeling a bit worried about the cooperative societies, because I had an experience of working in Jabalpur where I had interacted with India Coffee House, which is a cooperative society, which actually is a model cooperative society. It was providing hygienic food for like people at various nook and corners of most of the country, and they were also providing huge amount of employment opportunity to educated unemployed youth. In the process, they were also doing a wonderful job. They also do outsourcing work for guest houses of most of the government and PSUs in Maharashtra, Madhya Pradesh, Uttarakhand, UP, even Madhya Pradesh for that matter. So I found that they are doing, they are eligible for any incentive which domestic companies should also be eligible. So probably our colleagues in TPL realized that yes, this is one area which they missed out in the earlier lot. So at the earliest opportunity, they ensured that the cooperative societies are given this optional rate of getting taxed at a lower rate. So now I'm very happy that this thing has come, because quite a few cooperative societies are doing yeoman services, both for employment creation, for skill upgradation, and also for creating economic activity. In my earlier part of the lecture, I was telling you how Government of India is viewing not only the business community, but also other than business community by tweaking quite a few provisions so as to create activity, because sometimes non-economic activity, NGOs can also create a lot of activity which will result in a lot of economic activity, and correspondingly employment generation and other avenues. Then individuals and HUF continue to opt to get taxed at the rate specified for in Part 1 of first schedule or as per Section 115 BAC. Say, Part 1 of first schedule is that old scheme wherein you are eligible to be taxed at 10%, 20%, and 30%, or as per Section 115 BAC, as per which either 5%, 10%, 15%, 25%, and 30%. So, like we have this option. Of course, individuals and HUF having business or personal income are excluded from the purview of opting for Section 115 BSC. This is the second changes. Exemption for LTC cash scheme. So this is a announcement made by Government of India to promote more expenditure among the organized sector of the population, so as to create more demand for white goods and other services, which can again accelerate the activity of the economy. So post-COVID, as you all know, the lockdown resulted in virtually stoppage of economic activity, and later the private sector was feeling shy to make investment in economic activity. And whatever investment which they were actually planning to make investment, they were actually trying to postpone. So Finance Minister started monitoring the capital expenditure budget of the PSUs on a regular basis, and also FM was also examining whether the MSMEs are being paid by organized sector for the supplies made by them, so that sufficient liquidity is pumped into MSMEs and also to the businessmen for the sales which they can make. So exemption of LTC cash scheme is one such intended thing. So in this particular budget, this provision has been introduced. Second provision, subclause 5 of Section 10, provide for value in lieu of any travel concession or assistance received by or due to individuals shall also be exempt under this clause, subject to fulfillment of conditions to be prescribed. So here there will be condition, because as to what should be the GST rate at which that particular service is to be, goods or service to be enjoyed, and this is applicable only for assessment year 21-22. So this provision was injected as a it is a stimulus given, and Act is being amended to facilitate the implementation of this particular clause. Incentive for affordable rental housing. The existing provisions of Section 80 IBA of the Act provides that where the gross income of an assessee includes any profit and gains derived from the business of developing and building affordable housing project, they shall be subject to certain conditions specified therein, be allowed a deduction of an amount equal to 100% of the profits and gains derived from such business. One of the conditions for the project is approved by the competent authority after the first day of June 2016, but on or before 31st day of March 2021. To help migrant laborers and to promote affordable rental, it is proposed to allow deduction under Section 90 IBA of the Act, and also to such rental housing project which is notified by the central government in the official gazette and fulfills such condition as specified in the said notification. Further, it is also proposed that the outer time limit of 31st March 2021 in this section is getting the affordable housing project approved be extended up to 31/12/2022, and the same outer time limit be also provided for the proposed affordable rental housing project. This amendment will take effect from 1st April 2022 and will accordingly apply to assessment year 22-23 and subsequent assessment year. In other words, what was initially intended was being extended so as to ensure that the target class, that is the migrant labor class, and also to promote affordable rental, this particular scheme is being extended. Tax incentive for units located in International Financial Service Center, IFSC. Gone are the days when London or Singapore are going to be the International Financial Service Center. Many other centers are being promoted by the respective government with slew of incentives, and India is not anyway waiting any longer, and slew of tax incentives are being showered upon this International Financial Center. Various incentive schemes for the units which are going to be located in this International Financial Center have been provided with a view to make it as the financial hub. And I'm very sure that the way the scheme is panning up and the incentives are going to be given, India is going to be one of the international financial hub not very soon. Tax neutral conversion of urban cooperative bank into banking company. As an ex-banker, I can tell you that banking companies are better regulated than cooperative societies, and especially urban cooperative societies are not that well regulated. So over a period of time, you would have all seen how scams are being panning out at various places. The government would like to definitely encourage urban cooperative banks to get converted into banking companies, so that they come into the regulatory framework of Reserve Bank of India, so that there will be better regulation. There's going to be regular inspection, review, and also there will be a slew of regulatory compliance like cash reserve ratio and statutory liquidity ratio, and their investment portfolio are also going to be regularly monitored. With the result, these urban cooperative banks are not permitted to make dubious lending. So it is proposed to expand the scope of business of reorganization to include conversion of primary cooperative bank to a banking company, and directions available under section 44 DB of the Act shall also be made applicable in relation to such conversion of primary cooperative bank to the banking company. Further, it is also proposed that transfer of a capital asset by the primary cooperative bank to a banking cooperative society, rather to banking company as a result of conversion, shall not be treated as transfer under section 47 of the Act. Consequently, the allotment of shares of the banking company to the shareholders of the predecessor primary cooperative bank shall not be treated as transfer under the said section of the Act. So, in other words, the whole thing is going to be seamless. There's not going to be any tax implication whenever urban cooperative bank into banking company happens. Issuance of zero coupon bond by infrastructure debt fund. Like earlier, this infrastructure capital company or infrastructure capital fund or public sector company or scheduled bank alone were authorized to issue zero coupon bond. What does zero coupon bond mean? Zero coupon bond means in which no payment and benefit is received or receivable by the bondholder before maturity or redemption. So now even infrastructure debt funds are also permitted to issue such bonds. So this is going to also funnel huge amount of funds for infrastructure spending or infrastructure companies which are actually starved of long-term funds, which no more banks will be able to actually provide to them. Facilitating strategic disinvestment of public sector company. As I was telling you, this budget has an ambitious target of disinvestment of public sector company, and to facilitate, Act is being amended to facilitate Section 219 double capital A defines demerger, and Section 72A of the Act provides provision for relating to carry forward and set of accumulated loss and unabsorbed depreciation and allowance of amalgamation of demerger, etc. It is proposed to relax the provisions of these two sections for public sector companies in order to facilitate strategic investment of government. So this is an enabling amendment which will facilitate PSUs to go for demerger and also help in successful strategic investment of PSUs as being planned by the Government of India. Extension of date for sanction of loan for affordable residential house property. This is one more enabling provision to encourage housing for affordable section of the population. It is proposed to amend provisions of Section 80AAA of the Act to extend the outer date for sanction of loan from 31st March 2001 to 31st March 2022, deduction in respect of which interest on loan taken for residential house property from any financial institution up to rupees 1,50,000, subject to the condition that loan has been sanctioned during the period beginning on 1st April 2019 and ending on 31 March 2021. There are further conditions that the stamp duty value of the residential house property does not exceed 45 lakhs rupees and the assessee does not own residential house property on the date of sanction of loan. This provision allows deduction of to the first-time home buyers in respect of interest on home loans. In order to help such first-time home buyer, further it is proposed to amend the provision of sections 80 EEA of the Act to extend the outer date for sanction of loan from 31st March 2021 to 31st March 2022. This amendment will take effect from 1st April 2022 and will accordingly apply to assessment year 22-23 and subsequent assessment years. Extension of date for incorporation for eligible startup for exemption and investment in eligible startup. One is incorporation of eligible startup is one aspect. The second one is exemption of investment in eligible startup, because these are the two things. One is incorporation of startup itself is one aspect. The second one is also encouraging funneling of investment into eligible startup, because startup per se cannot survive. It also requires investment. So you also you not only require handholding for incorporation stage, but also for investment of eligible startup. The existing provision of Section 80 IAC of that, among other things, provide for deduction of an amount equal to 100% of the profit and gain derived by the eligible business by an eligible startup for 3 consecutive assessment years out of 10 years at the option of the assessee. This is subject to condition that the total turnover of the business does not exceed 100 crore rupees. The eligible startup is required to be incorporated on or 1st April 2016, but before 1st April 2021. The existing provision of Section 54 GP of the Act, among other things, provide for exemption of capital gain which arises from the transfer of long-term capital asset, being a residential property, a house or a plot or a land owned by the eligible assessee. The assessee is required to utilize the net consideration for subscription in the equity shares of the eligible startup before the due date for furnishing of income tax under subsection 1 of Section 139. It is proposed to amend the provisions of Section 180 AC to extend the outer limit of incorporation to before 1st April 2022. And it is also proposed to amend the provisions of Section 54 GB of the Act to extend the outer date of transfer of residential property from 31st March 2021 to 31st March 2022. This is going to give a lot of fillip to those entrepreneurs who are actually planning to go for a startup, and due to this COVID lockdown and restriction, they were not able to do it. This amendment by about 1 year, both for incorporation as well as for like investment, is going to definitely help them. Increase in safe harbor limit of 10% for home buyers and real estate developers selling such residential unit. Government of India realized that most of the flats which have been constructed have been remained unsold for a very long time, and you also would have realized that Section 24, wherein a provision was also introduced for taxation of unsold inventory of a infrastructure company. So, with a view to push sales and also to provide working capital to the big builders and builders having huge inventory, it was decided that some incentive is required to be given so that they can liquidate the inventory, and also which invariably result in affordable housing and also available rental for migrant laborers. And because in addition to migrant laborers, my view is that as I've lived in Bangalore, Chennai, and Hyderabad, and now I'm in Kochi, I can see that there is huge influx of even blue-collar workers and also technocrats into these cities, where they do look for, they are not interested in buying a property, but they are interested in hiring a property to live and work. Later, they may like to shift to Chandigarh, Lucknow, or Bhopal, or Mumbai, or any other place, or Calcutta, from where they all come from. So obviously, they are all looking for affordable rental accommodation. So if flats are available for rent, then obviously they would like to hire for a short time. So this increase in safe harbor limit for 10% is definitely will be a win-win situation for a local person who would like to buy a flat for the first time and also would like to let it out to somebody, and blue collar and technocrats would like to first time employee who would be working in cities where you have lot of IT activity taking place to operate from these places. So section 43 CA of the Act inter alia provides that where the consideration declared and received or accruing as a result of the transfer of land, building, or both is less than the value adopted for assessable by any authority of the state government, that is stamp valuation authority, for the purpose of payment of stamp duty in respect of such transfer, the values so adopted and assessed shall be the purpose of computing the profit or gain from transfer of asset be deemed to be the full value of consideration. In order to boost the demand in the real estate sector and to enable the real estate developers to liquidate their unsold inventory at a lower rate to the home buyers, it is proposed to increase the safe harbor threshold from existing 10% to 20% of the 43C of that in the following conditions as satisfied. The transfer of a residential unit take place during the period from 12th November 2020 to 30th June 2021. The transfer is by way of first time allotment of the residential unit to a person, and the consideration received or accruing as a result of such transfer does not exceed 2 crore of rupees. Further, it is proposed to provide the consequential relief to the buyers of this residential unit by way of amendment in clause 10 of subsection 2 of section 56 of the Act by increasing the safe harbor from 10% to 20%. Accordingly, this transaction circle rate shall be deemed as a sale or purchase consideration only if the variation between the agreement value and the circle rate is more than 20%. So from 10% it has been increased to 20%. So which will actually result in quite a few sales by most of these real estate builders who are stuck with unsold inventory. Rationalization of provision of relating to sovereign wealth fund and pension fund. I was telling you ILFS scam and NPA dilemma of banks are going to be the thing of the past. Rationalizations of provision relating sovereign wealth fund and pension fund is going to be a big game changer in bringing in huge amount of money, which is available with this SWF and PF, but they are only looking for safe and steady investment. So India Infra Story is the event which is going to be happening, and it's the story which is already being written, and it's only the first chapter is written, and about 5 to 6 chapters are going to be written, and it's going to be plated in gold for the simple reason that these are all solid stories where as you breeze through the toll roads, you all realize that now investing in toll is a good money-making business. Similarly, like ring roads, then national highways, golden corridors, then interior roads are all going to cost money, but funding, there is an asset liability mismatch in this whole scenario where the infrastructure, my personal view of most of the not so successful infrastructure story in Indian industry is more on account of asset liability mismatch, where the promoters try to make investment in a business proposition where the payoff is going to be 3, 5, 10 years down the line, whereas the repayment of loan is kick-starting in a matter of 1 or 2 years. So with the result, the promoters tend to adopt questionable means and they try to pressurize banks to give loans, and at some point of time they result in asset liability mismatch, and finally it results in question of solvency. Say asset liability mismatch beyond a point will finally result in solvency question. So rationalizations of provisions relating to SWF and PF is a big game changer. Developed economies have huge money available in SFF and PF, which is going to be funneled by if only the fiscal climate is also favorable to them. So clause 23 FE of section 10 of Act provides for exemption to specified persons from the income from the nature of dividend, interest or long-term capital gains arising from investment made by it in India. Specified persons of SWF or PF which fulfills the conditions prescribed therein or specified for this purpose by the central government through a notification in official gazette. This is a big ticket reform, and you can take my word for granted. In next 5 to 6 years down the line, the infrastory of government, infrastory of India is going to be on a level far beyond what you actually imagine. Addressing the mismatch of taxation of income from notified overseas retirement fund. Representations have been received that there is a mismatch in the year of taxability of withdrawal from retirement funds by residents who have opted to open such funds when they were non-residents in India and resident in foreign countries. At present, the withdrawal from such funds may be taxed on receipt basis in such foreign countries, while on accrual basis in India. In order to address this mismatch and to removal of this genuine hardship, it is proposed to insert a new section 89A to the Act to provide that the income of the specified from the specified account shall be taxed in the manner and in the year asked by this central government. So this again is one more sweetening for the retirement fund, where this is a very legitimate grievance, where on the one hand they make investment in India, and due to a time mismatch in the year of taxability, in the jurisdictional area where these funds come from, and India, there is a huge amount of grievance being faced by these institutions. So government has addressed this issue, and the corresponding amendment is being made, and this is going to sweeten the retirement fund investment in India. Rationalization of provisions of MAT. It is proposed to provide that in case where the past year income is included in the books of accounts during the previous year on account of APA or secondary adjustment, the assessing officer shall, on the application made to him on this behalf by the assessee, recompute the book profit of the past years and tax payable, if any, during the previous year in the prescribed manner. Further, the provisions of section 154 of the Act shall apply so far as possible, and the period of 4 years specified in the subsection 7 of section 154 shall be reckoned from the end of the financial year in which the said application is received by the assessing officer. To provide similar treatment to the dividend as already there for capital gains on transfer of securities, interest, royalty, and fee for technical services in calculating book profits for the purpose of section 115 JB of the Act, so that both the specified dividend income and expense claimed in respect thereof are reduced and added back while computing book profits in the case of foreign companies where such income is taxed at lower than MAT rate due to DTAA. So but like you need to excuse me for packing too many things in one single PowerPoint presentation. But since I'm reading out to you and all of you are tax administrator with 3 to 10 to 15 years of experience, so you can easily relate to me wherever the intensity of the PowerPoint is too high. So if you need, kindly tell me. I'll slightly slow down when I read out the presentation. Right? Exemption of deduction of tax at source on payment of dividend to business trusts in whose hand dividend is exempt. Section 194 of the Act provides for deduction of tax at source on payment of dividend to resident. Second proviso to this section provides that provisions of this section shall not apply to such income credited or paid to certain insurance companies or insurers. It is proposed to amend the second proviso to section 194 of the Act to further provide that provisions of this section shall also not apply to such income credited or paid to a business trust by a special purpose vehicle or payment of dividend to any other person as may be notified. So this particular benefit to a particular segment of a taxpayer. Rationalization of provisions of concerning withholding of payment made by FIAs. Representations have been received requesting that benefit of agreement under section 90 or section 90A of the Act may be considered at the time of tax deduction on payment to FIAs. Accordingly, it is proposed to insert a proviso to subsection 1 of section 196D of the Act to provide that in case of a payee to whom an agreement referred to in subsection 1 of section 90 or subsection 1 of section 90A applies, and to such payee as furnish the tax residency certificate referred to in subsection 4 of section 90 or section 4 of section 90A of the Act, then tax shall be deducted at the rate of 20% or rate of income tax provided in such agreement of such income, whichever is lower. So this is a very beneficial provisions for FIAs because they don't need to actually keep making application on a regular basis. So like as and when they fall into this particular category, so like as and when they opt for a particular this one, automatically TDS can be made at the rate at which they have to be made for them. Rationalization of certain provisions relating to tax audit of certain cases. A couple of years back, government decided that if business promotes digitized payment or payment online or payment through account pay check or draft, then regulatory compliance of tax audit should the bar should be raised much higher to them, because they are the people who are actually disclosing all their transactions online, or through they are doing the transactions through the banking channel. Maybe even in such cases also a particular percentage of cash transactions was provided for. So now in this budget, the bar is further raised higher. The regulatory compliance of tax audit is being liberalized in order to incentivize non-cash transactions, to promote digital economy, and to further reduce compliance burden of small and medium enterprises. It is proposed to increase the threshold from 5 crore rupees to 10 crore rupees in cases where because there are two components. One is aggregate of cash receipts, or the cash payments does not exceed 5% of the receipts or payments respectively. So in other words, if the cash receipts or cash payments of a MSME does not increase, does not exceed 5% of the total turnover or gross receipts, then they need to go for tax audit only if their aggregate cash receipt or cash payment or turnover is exceeding 10 crore, as against it was 5 crore. So through this process, a huge number of MSMEs will come out of the even tax audit burden. Advanced tax installment for dividend income. Now that even we are all liable for payment of tax on dividend income, because from this year onwards, we are liable to pay tax on not only interest on our savings bank account and FD interest, but also investment which we make on shares of a domestic company where we do get dividend. Of course, we are also going wherever we don't give form the necessary form 15G, etc., then the company itself may deduct even TDS there. But it's quite possible that quite a few people may be falling within that minimum maximum limit, which is not liable for TDS. So this provision is intended especially to them. The first proviso of subsection 1 of subscription 1 provides for the relaxation that if a shortfall in the advance tax installment or failure to pay the same on time is on account of income listed therein, no interest under section 234C shall be charged, provided the assessee has paid full tax in the subsequent advance tax installment. Assuming you receive Coal India dividend right in the first quarter of your financial year, you won't be eligible for this one. But Coal India will not just stop with declaring dividend right in the first quarter. Coal India is going to declare dividend again in the third quarter, and we are not very sure how much it is going to declare dividend. Coal India is quite liberal in declaring dividend, and even one installment of your dividend may be quite huge. So you obviously, when you are actually and if you have a robust PSU portfolio, you are likely to get a huge amount of dividend. If you are an investor in REC, if you are invested in Coal India, if you are an investor in Engineers India Limited, and if you are also going to be investor of quite a few OFS which is going to kick in with this aggressive disinvestment with the Government of India as planned, like SAIL, then Bharat Petroleum Corporation, then in this other petroleum sector, then finally most of us are going to be having huge amount of advance tax compliance burden. But if you are going to receive advance tax, if you are going to receive dividend declared in the third and fourth quarter, then definitely you can avoid provisions of section 234C by virtue of this beneficial provision. These exclusions initially were only for the purpose of capital gain and also for income of the nature referred to in subclause 9 of clause 24 of section 2, and income under the head profits and gains of business or profession in cases where income accrues or arises under the head for the first time. Maybe a person who has been just a passive investor for the first time is entering into the arena of business. So if he suddenly gets income from business and profession, already this beneficial clause was available. Now, income under the nature referred to on subsection 1 of clause 115 BBDA will also be coming under this provision. Of course, a relaxation is to insulate the taxpayers from the payment of interest under 234C of the Act in cases where accurate determination of advance tax liability is not possible due to the intrinsic nature of the income. Therefore, after considering various representations favorably, it is proposed to include dividend income in the above exclusion, but not deemed dividend as per subclause E of clause 22 of section 2 of the Act. So, in other words, even though 234C does not apply to dividend income, but it definitely applies to deemed dividend. So, the lawmakers have taken care to see that unintended loophole doesn't get into the law. Raising prescribed limit for exemption under clause 3AD and class 3AC of clause 23C of section 10 of the Act. So basically, subclause 3 of 3AD and 3AD talks of educational institutions, and 3AE talks of university and other hospitals. So, in order to provide benefit to small trusts and institutions, it has been proposed that exemption under subclause 3AD and subclause 3AE shall be increased to 5 crores, and such limit shall be applicable for an assessee with respect to aggregate receipt from university or universities or education institution or institutions as referred to in the respective subclauses. So, as I was telling you all, government is trying to reduce the compliance burden of not only the business class but also the service and other classes. Like this is a classic example of how universities, education institutions, and hospitals which are floated by small trusts and institutions, can take advantage of this ease of regulatory burden. Extending due date for filing of returns of income in some cases, reducing time limits to file belated returns and to revise original returns, and also to remove difficulty in case of defective returns. So the first thing is due date for filing return of income in some cases. Since the total income of a partner, because normally what happens is the partner can know what is his share of various things only after finalization of this one. By reading out of it, I think the provision will be made more clearer. Since the total income of the partner can be determined after books of accounts of such firms have been finalized, the due dates for the partners are already aligned with the due dates of the firm. Thus, the due date of the filing of original returns of income of such partners is 31st October of the assessment year. However, this relaxation is not there for spouses of such partners to whom Section 5A of the Act applies. Therefore, it is proposed that the due date for filing of original return of the income to be extended to 31st October of the assessment year in case of a spouse of the partner of the firm whose accounts are required to be audited under this Act or under any other law for the time being in force if the provisions of the Section 5A applies to them. In case of a firm which is required to furnish report from an accountant for entering into international transactions or specified domestic transaction as per Section 92E, capital E of the Act, the due date for filing of original return of the income is 31st November of the assessment year. Since the total income of such partner can be determined after the books of accounts of such firm have been finalized, it is proposed that the due date of such partner is extended to 30th November of the assessment year. With a massive technological upgrade of the department, where the process under the Act are moving towards becoming faceless and jurisdictionless, the time taken to conduct and complete such processes has greatly reduced. Therefore, it is proposed that the last date for filing of belated or revised returns of income, as the case may be reduced by 3 months. Thus, the belated return or revised return could now be filed 3 months before the end of the relevant assessment year or before the completion of assessment, whichever is earlier. It is proposed that the proviso be inserted in explanation to subsection 9 to section 139, empowering the board to specify by notification that any of the above conditions shall not apply for a class of assessees or apply with such modification as may be specified in such notification. This is intended to avoid difficulties for both taxpayers and the department, as many returns become defective by application of these provisions. So, in other words, due dates have been extended so as to logically connect the compliance burden of certain category of taxpayers, and also reducing the time limit available for filing belated returns and revising original returns have been intended so as to ensure that the whole proceedings can be completed at a sufficient pace so as to provide more certainty to the various taxation proceedings. Then the final removing difficulty, like section 139, explanation to subsection 9 to section 139, if it is applied omnibus, leads to declaring quite a huge number of returns as defective returns. So this whatever provision which is intended will ensure that both the department and the taxpayer don't suffer on account of omnibus application of explanation to subsection 9 of section 139. So I'll take a break at about maybe after the next slide, so that we can continue the second slide later part later, because since the whole presentation is going to be very information rich and requires a lot of concentration. Once I finish this payment by employer to employee, once I complete this, we can take a break. Payment by employer to employee contribution to fund or honor before due date. This is one. This one where as PCIT Kochi, I've been filing appeal before High Court in quite a few cases because there is a favorable judgment to the department in Kerala. Whereas when I was in Tamil Nadu, when I was representing before ITAT Chennai, when I fished out a one writ wherein the judge had given, a single member bench had given a judgment in favor of the department. The honorable bench intimated to me saying that that was withdrawn later because the double member bench in Chennai High Court has already taken a decision that payment by employer of employee contribution to the fund on or before due date is extendable as laid in section 43B. With contrary judgments in the field all over the country, Government of India decided that the matter has to be set right. So the controversy has to be set to section 35(6)(ba), read with section subclause 10 of subclause 24 of section 2. So it is a convergence of these things is what should have been read normally, but over a period of time it was read along with section 43B. Accordingly, in order to provide certainty, it is proposed to 1. Amend clause 5A of subsection 1 of section 36(1) of the Act by inserting another explanation to the said clause to clarify that provisions of section 43B does not apply and deemed to never have been applied for the purpose of determining the due date under this clause. Amend section 43B of the Act by inserting explanation 5 to said section to clarify that the provisions of section do not apply and deemed to never have been applied to a sum received by the assessee from any of his employees, to which provisions of subclause 10 of clause 24 of section 2 applies. So now any employee contribution deducted by the employer has to be deposited by the employer within the due date prescribed by that particular welfare fund, and the employer cannot take cover under section 43 anymore. And like when you are processing return or when you are scrutinizing return, you people need to be extremely careful in the change in amendment. And also my suggestion to all of you is that kindly review even your it's quite possible that in view of this amendment there can be consequential judgments coming from various judicial fora. So kindly keep track of the developments with regard to this area. Prospectively, this issue has been set to rest, and mind you, huge amount is involved whenever big corporates are involved. The amount is not in lakhs; it runs into crores. So you can understand the tax implication on account of this. So with this, I'll hold for time being. After a gap of about 10 minutes or so, we can resume. Back to the host.
Friends, we'll take a break of 10 minutes, and right now it is 12:32, so we can be back by 12:45. So we resume at 12:45.
Yeah, thanks.
So friends, we continue with the session, and last thing that we read was amendment in the section 36(5)(a), and certainly it carries a lot of budget ramification, and therefore we all need to focus a lot on what the government is trying to do through these amendments. And as sir explained to you, that after this amendment, what is going to happen is that since 43B is no longer applicable, so all the businessmen will have to perforce pay the dues of the employees deducted by them in time, within time, and otherwise they will not be able to get the deduction for that. And it's a big issue for not only big companies but medium companies and other companies, other firms also who are employing people, because there are certain delays do happen from time to time, and but now if they delay it, then they will not be able to get a deduction. So it's a very serious matter, and government is therefore very serious that every employer must pay the deducted dues of the employee within to the government account or to the relevant fund account within the due date. So it's very interesting. So with those words, I welcome Ramkrish sir once again, and to request him to begin his presentation.
Yeah, thanks Arvind Bhai. I'll starting again. Next is Constitution of Dispute Resolution Committee for Small and Medium Taxpayers. So I was emphasizing one point in the beginning of my lecture, that was that ease of tax compliance. So among ease of tax compliance measures, pre-filled form consisting of even interest and dividend details, then like increasing the tax audit limits, then advanced tax rule for dividend income are few provisions. But icing in the cake would be the Constitution of Dispute Resolution Committee for Small and Medium Taxpayers. The new scheme is proposed to be incorporated in a new section, Section 245, capital MA, and has following features. The central government shall constitute one or more dispute resolution committee, DRC. This committee shall resolve disputes of such persons or class of persons which shall be specified by the board. The assessee would have an option to opt for or not opt for the dispute resolution through the DRC. Only those disputes where the written income is 50 lakhs rupees or less, and the aggregate amount of variation proposed in the specified order is less, is 10 lakhs or less, shall be eligible to be considered by the DRC. So essentially, if you see the provisions, one is the option is given to the taxpayer. So taxpayer can always opt for the conventional litigation route, or he can they can opt for a dispute resolution committee. So the second factor is it is intended mainly for the small taxpayers and MSMEs. So MSMEs are not equipped with too much of resources to fight for their cause. So probably they may find it convenient to handle a situation even if they don't have a full-time chartered accountant, but still with a tax consultant, probably they will be the promoter along with the tax consultant can appear before the dispute resolution committee and put forth the factual matrix of the case and put forth their point of view very nicely. So these DRCs are more accessible to the taxpayers than the conventional appellate forum, which are more opaque in their nature. First of all, in the things as they stand, small disputes are not a priority of the system. Only recently, board took cognizance of this factor and decided that small appeal should also be categorized as the priority. Like till such time, we have history of cases where more than like I could see in because now I'm handling this Viva to Vishwa scheme in Kerala, where I find appeals filed way back in 2004-5 are still pending at first appeal, not leave aside even second or higher fora. That is a scenario in our system due to various reasons. So definitely this is going to be a big benefit for small and medium taxpayers. If the specified order is based on search initiated under section 132 or requisition and made under 132E or a survey initiated under 133A or information received under an agreement referred to under section 90 or 90A of the Act, such specified order shall not be eligible for consideration by DRC. So negative list is also in place. So like only taxpayers who have clean history obviously will fit into this scheme of thing. Assessors would not be eligible for the benefit of this provision if there is a detention, prosecution, or conviction under various laws as specified in the proposed section. Board will prescribe some other conditions in due course which would also need to be satisfied for being eligible under this provision. So here I would like to emphasize one factor. Whenever we read the Finance Bill or Finance Act, and whenever there is a proposition like this, we as the departmental officers are duty bound to react if we feel if government has missed out certain things. Then probably immediately we bring it to the notice of our higher authorities through our hierarchy, through TPL, that maybe certain conditions which are not foreseen here also should not come into this thing. Maybe you may also have a case of Hawala operator. Maybe you feel that Hawala operator should not get the benefit of this particular scheme, or like I'm just giving you one such instance. The DRC, subject to such conditions as may be prescribed, shall have the powers to reduce or waive any penalty imposable under this Act or grant immunity from prosecution for any offence under this Act in case of a person whose dispute is resolved under this provision. This is a takeaway provision of this particular section. Say, like here we are having a virtually a settlement commission sort of a scenario operating. We are all tax administrators having put in lot of years of service. We do find cases here and there. We feel that even though we detect concealment, at one point of time we feel that this is a very unfortunate case of where we have no option but to levy 201C. So we don't find comfortable in like dropping penalty proceedings. But now there is a right royal view available. Whenever you do find a case, there are cases where software professionals, they keep moving from place to place. The scrutiny notice doesn't reach them. Subsequently, they don't have time to go through the questionnaire. Subsequently, the department makes an addition. Sometimes it may even result in concealment because they would not have disclosed the interest from savings bank account as taxable income. So the moment the assessing officer calls for the bank account, immediately he can find out what is the concealment. So it's a full-fledged case for prosecution. So those are such cases now can easily get into this dispute resolution committee for small and medium taxpayers. So the Roman 6, the board does the onus to prescribe some other conditions in due course which would also need to be satisfied for being eligible under this provision. My request to all of you is to kindly brainstorm and identify areas where unintended people should not take advantage of the benefit. Say, we as a department have collective experience of more than 30 to 45 years cutting across the years of service, right from the person who joined just about 1 year back to the person who is going to retire maybe the next month. So we have that sort of resource available in the department. We as the department should definitely react and see that this provision is well clothed so that intended people get the benefit, but unintended people don't get benefit out of this scheme. Constitution of Board of Advance Ruling. I was saying in the beginning that advanced ruling as it was there earlier.
So the presentation is not shared, I think.
Oh, okay, 1 second. Now it's okay. Are you able to see Constitution of Board for advanced ruling?
Not yet, sir.
Now it's okay. Now you are able to see.
Not yet, sir.
Yeah, I'll just.
Yes, sir. Now it is visible.
Yeah, Constitution of Board of Advanced Ruling. It is proposed to constitute a board of advanced ruling and to make following amendment to the existing provisions of AR. The authority of advanced ruling shall cease to operate with effect from such date as may be notified by the central government in the official gazette. It is proposed that central government shall constitute one or more board for advanced ruling for giving advanced rulings under the said chapter on and after the notified date. Every such board shall consist of 2 members, each being an officer not below the rank of Chief Commissioner. Adverse rulings of such board shall not be binding on the applicant or the department, and if the aggrieved, the applicant or the department may appeal against the ruling or order passed by the board before the High Court. Since the work of authority shall be carried out by the board for advanced ruling on and after the notified date, amendments are proposed to be made to the various provisions of chapter to this effect. Section 245N is proposed to be amended to incorporate the definition of the Board of Advanced Rulings, notified date, member of the Board of Advanced Rulings, and changes in the definition of authority to include the Board of Advanced Ruling. Other consequential amendment in the Act is also being made in the relevant rules. Next, income escaping assessment and such assessments. So there is a sea change in the way the department is going to function now that we are doing faceless assessment. Even the way we need to reopen the assessment and also to do such assessment has also undergone a major change. So my request to all the participants is to kindly focus on this important area, because this has already President of India has already given accent to the finance bill on 28th of March. So now it is the law. It proposes to completely a new procedure of assessment of such cases. It is expected that the new system would result in less litigation and would provide ease of doing business to taxpayers, as there is a reduction in time limit by which a notice for assessment or reassessment or recomputation can be issued. The salient feature of the new procedure are as under. The provisions of section 153A and 153C of the Act are proposed to be made applicable to only search initiated under Section 132 of the Act or books of accounts or other document or any asset requisition under 132A of the Act on or before 31st March 2021. That means all searches taking place after 1st April will come under the new scheme. Assessment or reassessment or recomputation in case where search is initiated on 132 or requisition made in 132A after 31st March 21 shall be under new procedure. The Section 147 proposes to allow the assessing officer to assess or reassess or recompute any income escaping assessment for any assessment year. Before such assessment or reassessment or recomputation, a notice is required to be issued under Section 148 of the Act, which can be issued only when there is information with the assessing officer which suggests that the income chargeable to tax has escaped assessment in the case of the assessee for the relevant assessment year. Prior approval of specified authority is also required to be obtained before issuance of such notice by the assessing officer. So that means, in other words, some sort of a satisfactory note type of a thing need to be prepared and got approved by a higher authority before issuing notice under 148. It is proposed to provide that any information which has been flagged in the case of the assessee for the relevant assessment year in accordance with the risk management strategy formulated by the board shall be considered as information which suggests that the income chargeable to tax has escaped assessment. The flagging would largely done by the computer-based system. Further, a final objection raised by the Comptroller and Auditor General of India to the effect that the assessment in the case of an assessee for the relevant assessment year has not been in accordance with the provisions of the Act shall also be considered as information which suggests that income chargeable to tax has escaped assessment. In other words, even an RAP objection can also be a basis for the department to initiate the 148 proceeding. Further, in such survey and requisition cases initiated or made or conducted on or after 1st April 2021, it shall be deemed that the assessing officer has information which suggests that the income chargeable to tax has escaped assessment in the case of the assessee for the 3 assessment years immediately preceding the assessment years relevant to previous year in which such is initiated or requisition is made or a material is seized or requisition of survey is conducted. That means 3 years automatic opening is possible the moment search or survey get initiated. New Section 148A of the Act proposes that before issuance of notice, the assessing officer shall conduct inquiries if required and provide an opportunity of being heard to the assessee. After considering his reply, the assessing officer shall decide by passing an order whether it is a fit case for issue of notice under Section 148 and serve a copy of such order along with such notice on the assessee. The assessing officer shall, before conducting any such inquiries or providing opportunity to the assessee or passing such order, obtain the approval of specified authority. However, this procedure of inquiry, providing opportunity and passing of order before issue of notice under 148 of the Act shall not be applicable in search or requisition case. So that means here both 148 as well as search related the 148 cases are being discussed. So there they have said that the search note relating are not applicable for those cases. The time limit for issuance of notice under 148 of the Act is proposed to be provided in Section 149 of the Act and is as below. In normal case, no notice shall be issued if 3 years have elapsed from the end of the relevant assessment year. Notice beyond the period of 3 years from the end of the relevant assessment year can be taken only in few specific cases. In specific cases where the assessing officer has in his possession evidence which reveal that the income escaped assessment represented in the form of assets amount or is likely to amount to rupees 50 lakhs or more, notice can be issued beyond the period of 3 years, but not beyond the period of 10 years from the end of the relevant assessment year. Another restriction has been provided that the notice under Section 148 of the Act cannot be issued at any time in the case of the relevant assessment year beginning on or before 1st April 2021 if such notice could not have been issued at the time on account of being beyond the time limit prescribed under the provisions of Clause B as adjusted immediately before the proposed amendment. So that means, I'll read it out again. Another restriction has been provided that notice under Section 148 of the Act cannot be issued at any time in the case for the relevant assessment year beginning on or before 1st April 2001 if such notice could not have been issued at the time on account of being beyond time limit prescribed under the provisions of the Clause B as adjusted immediately before the proposed amendment. since the assessment or reassessment or recomputation in such a requisition cases, where such a requisition is initiated or made on or before 31st March 2001, are to be carried out as per the provisions of section 153A, 153B, 153C, and 153D of the Act. The aforesaid time limit shall not apply to those cases. It is also proposed that for the purpose of computing the period of limitation for issue of section 148 notice, the time or extended time allowed to the assessee in providing opportunity of being heard or period during which such proceedings before the issuance of notice under section 148 are stayed by an order or an injunction of a court shall be excluded. So this is important. So you do get some extra time whenever there is some disruption. That includes even the opportunity time given to the assessee to get back. Also can be factored. If after excluding such period, time available to the assessing officer for passing an order about fitness of the case for issue of 148 notice is less than 7 days, the remaining time shall be extended to 7 days. The specified authority for approving inquiries, providing opportunity, passing order under section 140A of the Act, and for issuing notice under 148 of the Act are proposed to be principal commissioner or principal director or commissioner or director if 3 years or less than 3 years have elapsed from the end of the relevant assessment year. Principal chief commissioner and principal director general, or where there is no principal chief commissioner, principal director general, chief commissioner or director general, if more than 3 years have elapsed from the end of the relevant assessment year. Once assessment or reassessment or recomputation has started, the assessing officer is proposed to be empowered as at present to assess or reassess the income in respect of any issue which has escaped assessment and which comes to his notice subsequently in the course of proceedings under this procedure, notwithstanding that procedure prescribed under section 140A was not followed before issuing such notice for such income. So in other words, income escaping assessment and such assessment, elaborate procedure has been laid out, where they have retained a little bit of what was there in the earlier, but thematically major changes have come. So my request to all the participants is kindly familiarize yourself with these provisions, since like you people need to act depending upon the requirement. So being familiar with this provision, which has a direct impact on your day-to-day working, should not be less emphasized. Allowing prescribed authority to issue notice under clause 1 of subsection 1 of section 142. It is proposed to amend the provisions of clause 1 of subsection 1 of section 142 to empower the prescribed income tax authority besides the assessing officer to issue notice under the said clause. So like faceless 142(1) is going to be the norm. The central government is following a conscious policy of making all the processes under the Act where physical interface with the assessee is required fully faceless by eliminating person-to-person interface between the taxpayer and the department. In line with this policy, and in order to enable centralized issuance of notices, etc., in an automated manner, it is proposed to amend the provisions of clause 1 of subclause 1 of section 142 to empower the prescribed income tax authority besides the assessing officer to issue notice under the said clause. This amendment will take effect from 1st April 2021. I'm very sure that within a matter of a month, we can expect a flooding of notices under section 142(1) issued from our central server, because now that the time limit for filing return is over as on 31st March. So non-filers, especially recently I had an occasion to interact with one chartered accountant. So I was asking why Taxpayers is still lobbying to get the time limit for the due date for request to be lobbying is being done by the bar. You are saying that due to this COVID restrictions, even many regular taxpayers have not got their books audited, so they have not filed the return of income. So, like we may have quite a few cases of non-filers, rather stop filers this year. They may not be stop filers in the conventional sense of the term, but due to this factor you will find, so system may be able to unearth quite a few of them. So it will be a very attractive proposition to immediately give effect to this. Huge number of cases is likely to surface based on my field knowledge. Provision of faceless proceedings before the income tax appellate tribunal in a jurisdiction-less manner. So now it is the turn of ITAT to go faceless, as we all went in the first stage and thereafter CAT appeals followed, and now it is the turn of ITAT. It is proposed to insert a new subsection in section 255 of the Act so as to provide that the central government may notify a scheme for the purpose of disposal of appeal by the ITAT so as to impart greater efficiency, transparency and accountability by eliminating the interface between ITAT and the parties to the appeal in the course of proceedings to the extent technologically feasible, optimizing utilization of the resources through economics of scale and functional specialization, introducing an appellate system with dynamic jurisdiction. It is also proposed to empower the central government for the purpose of giving effect to the scheme made under the proposal of subsection for issuing notification in the official gazette to direct that any of the provisions of this Act shall not apply or shall apply with such exceptions, modifications and adaptations as may be specified in the notification. Such directions are to be issued on or before 31st March 2023. It is proposed that every notification issued shall, as soon as may be after the notification is issued, to be laid before each House of Parliament. So, in other words, faceless appellate tribunal is a work in process which is happening. Over a period of time, appellate tribunal will go faceless as and when the notification is issued. Discontinuance of Income Tax Settlement Commission. So this is one major development this year. You are all aware that there are 4 benches functioning. Not 4. In 4 metropolitan cities, settlement commission benches are functioning: Delhi, Mumbai, Kolkata, and Chennai. And we have 3 benches in Delhi, 1 principal bench and 2 benches. Then there are 2 benches in Mumbai and 1 each in Calcutta and Chennai. With effect from 1st February 2021, it has been decided that ITASC shall cease to operate on or after 1st February 2021. No application under Section 245C of the Act for settlement of cases shall be made on or after 1st February 2021. So what happens to the applications which are already pending? Because the moment it is curtailed for ITSC as on 1st February 2021, there could be quite a few cases where assessee would have already filed an application, or applications would have been accepted, and reports might have been called for by the ITSC. So all these applications that were filed under Section 245C of the Act and are not declared invalid under subsection 2C of the Act, and in respect of which no order under 245D4 of the Act were issued before 31st January, shall be treated as pending applications. So this pending application will be handled by a board consisting of 3 chief commissioners of the Income Tax Department. So the government CBDT will be constituting boards at Delhi, Mumbai, Kolkata, and Chennai. Depending upon the workload, number of boards will be constituted, and all pending applications will be disposed of in the manner in which the earlier settlement commission was disposing the application, like after admitting, conducting enquiries, conducting hearing, and subsequently passing order under 245D. So after 1st February 2021, Government of India has prohibited the filing of application before settlement commission. Of course, I understand from the tax bar Kerla that about a few applications were filed by them before ITSC Chennai by the direction of Kerala High Court, but the matter is sub judice, so we don't know what will be the state of affairs. But now that it looks very clear that even assuming if those applications are permitted to be and agreed to be accepted, then obviously the board will handle even those cases. Otherwise, those cases will be rejected at the threshold level itself, since Settlement Commission stood abolished with effect from 1st February 2021. Reduction in time limit for completing assessment. So this is one more provision to bring in certainty with regard to tax proceedings. The assessment procedure is now conducted in a completely faceless and jurisdictionless way, where all internal and external communication is made electronically, and different aspects of the assessment procedure like verification, scrutiny of books of accounts, etc. are carried on by different units. The person-to-person interface between taxpayer and the department has been eliminated. This team-based approach for assessment with a dynamic jurisdiction is technologically driven and very efficient. Thus, the time required for completion of assessment procedure need to be further reduced. The benefit of shorter time period for scrutiny proceedings are manifold. On the one hand, it reduces the compliance burden on the taxpayers, who find it easier to explain the matters pertaining to a recent previous year, which is also improve the ease of doing business. On the other hand, it enhances the ability of the department to detect and bring to tax any leakage of revenue, as instances of tax evasion come to the notice of the department within a shorter span of time. Hence, it has been proposed that the time limit for completing assessment proceedings may be reduced further by 3 months. Thus, the time for completing assessment is proposed to be 9 months from the end of the assessment year in which the income was first assessable for the assessment year 21-22 and subsequent assessment years. Rationalization of the provisions of charitable trust and institution to eliminate possibility of double deduction while calculating application or accumulation. So this is one more beneficial provision to the trust and other institutions. A lot of litigations were happening on account of this. So this rationalization is expected to bring in lot of clarity to ensure that there is no double counting while calculating application or accumulation. It has been proposed that voluntary contribution made with specific direction that it shall form part of a corpus shall be invested or deposited in one or more forms of or modes specified in subsection 5 of section 11 maintained specifically for such corpus. Application out of corpus shall not be considered as application for charitable or religious purposes for the purpose of third proviso of clause 23C and clause A and B of section 11. However, when it is invested or deposited back into one or more of the forms or modes specified in subsection 5 of section 11, maintained specifically for such corpus from the income of the previous year, such amount shall be allowed as application in the previous year in which it is deposited back to corpus to the extent of such deposit or investment. Application from loans and borrowings shall not be considered as application for charitable or religious purposes for the purpose of third proviso of clause 23C and clause A and B of section 11. However, when the loans or borrowing is repaid from the income of the previous year, such repayment shall be allowed as application in the previous year in which it is repaid to the extent of such repayment. Clarity in both clause 23C of section 10 and 11 that for the computation of income required to be applied or accumulated during the previous year, no set-off of deduction or allowance or any excess application of any of the year preceding or previous shall be allowed. This amendment will take effect from 1st April 2022 and will accordingly apply to assessment year 22-23 and subsequent assessment. In other words, especially officers who have handled trust assessments, you will realize how difficult it is to make assessment of a trust, since claims and counterclaims used to be made, and even appellate authorities used to get confused. Now, with the introduction of these provisions, there is a lot of clarity with regard to the way the trusts are to be assessed. So now there is clarity. Yeah, it's only the receipts and payment which are to be analyzed, which are like capital things like loans and borrowings are not considered as receipt. Only repayment of loan out of the receipts will be considered as application. So this provision is long awaited, and it's welcome move, which make even assessment of trust simple, and complaints burden among the trust assessees also will be better now. Taxation of proceeds of high premium unit linked insurance policy. Like ULIP used to be one of the major tax avoiding investment available to most of the high net worth individuals or even institutions for that matter. Under the existing provisions of the Act, there is no cap on the amount of annual premium being paid by a person during the term of the policy. Instances have come to the notice where high net worth individuals are claiming exemption under this clause by investing in ULIP with huge premium. Allowing such exemption in policies with huge premium defeats the legislative intent of this clause. So what was the legislative intent of this clause? The legislative intent of this clause was that certain provisions are basically intended for lower end of the spectrum of the taxpayers. But since there was no express cap on the ceiling of investment to be made, at one point of time, high net worth individuals and other, they thought that this is an excellent way to save tax. So accordingly, they started investing heavily. So with the result, most of these schemes do have some amount of social subsidy built in. Unfortunately, it was not actually reached. In other words, by this tax swap was going to unintended beneficiaries like high net worth individuals. So, with the introduction of this particular provision, this loophole has been properly plugged. But at the same time, the lower end of the spectrum of taxpayers will not be prevented from enjoying it, because a person who is contributing a policy where he is paying an annual premium of more than 2,50,000 obviously is better, more well off than a person who is contributing a policy whose annual premium is less than 2,50,000. So obviously a person contributing less amount definitely deserves better, more tax off. The exemption under this clause shall not apply in respect with respect to any ULIP issued on or after 1st February 2001 if the amount of the premium payable for any of the previous year during the term of the policy exceeds 2,50,000 rupees. If premium payable by a person for more than one ULIP issued on or after, that is, if splitting also will be connected, and only the cap of 2,50,000 is maintained. However, the law has taken care to see that in case of an untoward event happening, it should not affect the beneficiaries. So accordingly, it says it should not apply to any sum received on death of a person. Rationalization of the provisions of slump sale, like especially in the case of amalgamation restructuring, and like in the corporate restructuring process, lot of questionable transactions are being carried out only with a view to avoid tax. So rationalization of the provisions of slump sale as proposed in Finance Bill and subsequently as fine-tuned by Finance Act will take care to see that these like this tax avoidance intent are defeated. A transfer which in effect and substance is by way of sale is also currently covered in the definition of slump sale under sections 50C of the Act as interpreted by various courts. However, it is still seen that the tax avoidance schemes are drawn to defeat the intent of this provision, and courts can always intervene to find the true substance of the transaction and purpose of section 50C of the Act. In order to make the intention clear, it is proposed to amend the scope of this definition of the term slump sale by amending the provisions of clause 42C of section 2 of the Act, so that all types of transfer as defined in clause 47 of section 2 of the Act are included within its scope. Rationalization of provision of transfer of capital asset to partner on dissolution or reconstitution. This Finance Bill underwent some amount of fine-tuning when it was finally passed as a Finance Act. Subsection 4 of section 45 provides that the profits and gains arising from the transfer of a capital asset by way of distribution of capital asset on the dissolution of the firm or other association of persons or body of individuals, not being a company or a cooperative society, or otherwise shall be chargeable to tax as the income of such firm or other association of person or BOI of the previous year in which said transfer takes place. Further, the fair market value of the asset on the date of such transfer shall be deemed to be the full value of consideration for the purpose of section 148. It has been noticed that there is uncertainty regarding applicability of provision of aforesaid subsection to a situation where the assets are revalued or self-generated assets are recorded in the books of accounts and payment is made to partners or members which is in excess of his capital contribution. Hence, it is proposed to substitute the existing subsection 4 of section 45 of the Act with the new subsection 4 and also insert a new subsection 4 capital A of the subsection. The proposed subsection 4 of section 45A Act applies to a case where a specified person who received during the previous year any capital asset at the time of dissolution or reconstitution of the specified entity. The proposed subsection 4A of section 45 of the Act applies to a case where the specified person receives during the previous year any money or other assets at the time of dissolution or reconstitution of a specified entity. Provisional attachment to in case of fake invoices cases. Say section 281B normally you apply, but one more circumstances under which you can invoke section 281B is provided now. Section 271 AAD of the Act was inserted by Finance Act 2020 to impose penalty on a person or person who causes such person to make a false entry or omit an entry from his books of accounts. It is an anti-abuse provision. Upon initiation of such penalty proceedings, it is highly likely that the taxpayer may also evade the payment of such penalty if imposed. Hence, in order to protect the interest of revenue, it is proposed to amend the provisions of 281B of the Act to enable the assessing officer to exercise the powers under this section during the pendency of proceedings for imposition of penalty under section 271 AAD of the Act if the amount or aggregate amount of penalty imposable is likely to exceed 2 crores rupees. Then rationalization of provision of equalization levy under section 165 of the Finance Act 2016 as inserted by section 153 of the Finance Act 2020. Equalization levy is to be levied at the rate of 2% of the amount consideration received or receivable by an e-commerce operator from e-commerce supply or service made or provider or facilitated. So this is one provision which debated a lot of headline both nationally and internationally. Now this has been fine-tuned, and India is one of the few countries which have taken lead in initiating this equalization levy, and I would say very rightly so, because like Indians are India is one big market for international e-commerce firms, so they generate huge amount of profits by dealing with Indians. So obviously the like profit generated out of e-commerce carried out with India, obviously even though they only have a digital presence, they also need to contribute to the exchequer, and these provisions have been fine-tuned. I think they followed this OECD model, and accordingly they have done it. So the department is on a great footing, and a huge amount of revenue is likely to accrue to the government of India on account of this levy. It is proposed to carry out this following amendment in the Finance Act 2016. Insert an explanation to section 163 of Finance Act, clarifying that consideration received or receivable for a specified services or consideration received or receivable for a e-commerce supply or services shall not include consideration which are taxable as royalty or fees or technical services in India under Income Tax Act, read with an agreement notified by the central government under section 90 or 90A of Income Tax Act. Insert an explanation to section 163 of Finance Act, clarifying that the consideration received or receivable for specified services and consideration received or receivable for e-commerce supply or services shall not include consideration which are taxable as royalty, all those things, right? But an amendment made in Finance Act to clarify that the equalization levy would not be applicable on consideration of sale or goods and services which are owned by persons resident of India or a permanent establishment of a non-resident Indian. That means, in other words, if an e-commerce company from US, if it carries out a transaction where movement of goods takes place from Mumbai to Chennai, then also equalization levy will not take place, because the transaction is actually taking place in India. Obviously, the transaction will anyway will be liable for tax as a domestic transaction as well. Depreciation of goodwill. So this is one more abuse provision which was abused. So both Finance Bill and Finance Act has also carried out whatever proposal done by Finance Bill has been fine-tuned in Finance Act, and it has been given a shape. My request to all of you is to kindly go through, especially the ones who are dealing with corporate cases. You will have a lot of cases of goodwill coming in your way. I think I'm running out of time. I have a few slides which I'll fast track. Rationalization of provisions relating to proceedings, processing of returns and issuance of notice under section 143(2). So now I'm just going to the last this one. Consequently, it is also proposed to reduce the time limit for issue of notice under subsection 2 of section 143 from 6 months to 3 months from the end of the financial year in which the return is furnished. So the time available to issue notice under 143(2) notice has been reducing over a period of time. That has been reduced further to 3 months now. Rationalization of provision of presumptive taxation for professionals under section 44 ADA. LLP already says that LLP Act makes it mandatory for LLPs to maintain books of accounts. So obviously they cannot opt for 44 ADA. So now this is only an enabling provision in Income Tax Acts to prohibit LLPs from opting for 44 ADA. Clarification regard to scope of Vivat Vishwas Act. Quite a few settlement commission cases are under litigation before high courts, so they were trying to take advantage of Vivat Vishwas scheme. So there is a clarification on that. It says that settlement is not a normal appellate provision, so hence they are not eligible for Vivat Vishwas scheme. Definition of the term liable to tax. So this was also required, since the term liable to tax is not defined in Income Tax Act. Now it has been defined to take care of the requirement in certain sections like section 1023 FE, then section 90 and 90A and all. Income declaration scheme amendment. Now it is now proposed to amend the proviso of section 191 of Finance Act 2016 so as to provide that excess amount of tax, surcharge and penalty paid under a declaration made under a scheme shall be refundable to the specific class of persons without payment of any interest. This amendment will take effect. So it's a beneficial clause to some of them who are otherwise not eligible, but now they can claim refund. TDS on purchase of goods. This is a very, very important provision. So like whenever a person whose turnover of sale of goods gross receipt during the financial year is exceeding 10 crore, and if he or she purchases goods exceeding 50 lakhs from a resident, then TDS of 0.1% need to be made. But if the seller has no PAN, then the TDS rate applicable is it goes up to 5%. So idea is to bring in more compliance. Some of you may be aware of the concept of URD sales and sales tax. So this is some sort of a parallel scheme. Then TDS TCS for non-filers at higher rate. So higher TDS TCS rates for non-filers of income tax return deductees. So if the deductee is not like if deductee is not filing, you're a deductor, but your deductee is not filing the return and disclosing the transaction, then in such a case you are supposed to deduct twice the rate specified, or twice are the rate at the rate in force, or the rate of 5%. So depending upon the this one, but exception is provided. These sections are not are coming outside the purview. Like for instance, we as a salaried class obviously will not come into this picture because we are covered under a different section under TDS itself. Taxability of interest on various funds where income is exempt. Like this is one thing which there has to be animated debate was happening immediately after presentation of finance bill. It is proposed to insert proviso to clause 11 and clause 12 to section 10 of the act providing that provisions of these clauses shall not apply to interest income accruing during previous year in the account of person to the extent relates to the amount or aggregate amount contribution made by the person exceeding 2,50,000 in the previous year in that fund or on or after 1st April 2021, computed in such manner as may be prescribed. But Finance Act now has amended the proposal by increasing the non-taxable limit of contribution to Provident Fund in cases of funds where there is no employer contribution up to 5 lakhs. So that means GPF contribution up to 5 lakh can be done, whereas CPF and other the cap of 2.5 lakh by the employee will still remain. With this, I conclude my presentation, and I thank ADG DTRTI Lucknow for giving me an opportunity to make a presentation which was very knowledgeable and rewarding to me, and also an opportunity given to share with all of you. And my personal thank to my dear friend Arvind for providing me this forum. Thank you.
Thank you very much, sir, for your wonderful session. And we had an opportunity to look into so many great amendments that have come in this year. Amendments that we need to be particularly focused upon to understand how things are changing and how the government is thinking and taking forward the provisions of the Income Tax Act. Particularly, I found it very interesting where they've imposed a duty to deduct tax where a person is buying some commodities more than 50 lakh rupees if his turnover is 10 crores and above. Certainly, through all these moves, the government is at one side is giving tax incentives. On the other hand, it is tightening the belt and the noose for those people who are not complying, particularly those who are not being kind to their employees. And of course, the TDS being a major part of the collections, there is always a focus of the government on TDS. The Act has been already passed and enacted, and therefore these provisions have become law. Therefore, we all need to be well versed with them. In that light, in a very short period of time, sir, you had kindly agreed to deliver this session for us, and you have, in a very short period of 2 hours, you have delivered all the sessions, all the amendments to us, and therefore we are very feeling gratitude for you. And on behalf of the DTRTI Lucknow and all its members, we are grateful that you have become a part of this session of today, this course of today. Whatever responses we get from the participants, we'll try to send them across to you. So even the participants are advised that if they want to send some communication, you can always send it to Sir on his income tax email. Surely, if you want to raise any discussion, you can gear yourself up, because we'll meet again for some discussion, for some exchange of ideas in the afternoon today. If you have some ideas, if you want to say something, you want to speak out, or you want to understand something better, it's a great opportunity, because discussions and deliberations are a key to understanding things in a better manner. So, keeping all this in mind and having great session and a great 2 hours of experience, we are all, I'm sure we are all feeling that we are much more benefited, and perhaps if we had skipped out earlier as to what changes come, this year, and perhaps we are reminded of that, and we'll have an occasion to go into the provisions more deeply and to understand them. And I'm sure that once the taxman also updates it on their website, I found that taxman has still to update a few things, particularly this year's amendments. Then they will all be available to us. Till that time, we should look at the memorandum of the explanation and the finance bill and try to understand the provisions and how they are connected with the past provisions and what change uh, has been brought out this year. So it's lunchtime, and therefore we request all the participants to have their lunch and keep safe, because COVID is also increasing. Yesterday we had more than 1,03,000 cases in the country. Good thing is that I think we all have learned to deal with it also in a big way. So perhaps in spite of the numbers, we should be safe and keep asking yourself, keeping distance, sanitization, and all those things. Take care of yourself and come back at PM today. Together. So with those words, thanking profusely Sir Ramakrishanan sir for having joined us from Kochi today, and on behalf of the participants of this webinar as well as from DTRTI Lucknow. Thank you so much, sir, and we'll be in touch with you constantly to gain more experience and knowledge from you even in the future. So thank you once again, and a goodbye to participants for the meanwhile. Come back 3 p.m. and we see you there. Thank you.